Hey, good afternoon, traders. Today is Monday, February 13th, 2017. This is Trader Tim coming to you from E-mini.com. And we're looking at the ES today. We'll look at some of the trades from last week, talk about the week ahead. First off, the last 4 days we have broken out and reached our target, both of the most recent 50% retracement to 2262.25 that had a target at 1312. And then all the way back down here at 2086s, that had a negative 61.8, all the way up here at the 2320 level. And these two levels, these negative 23 and negative 61, all that is a move beyond highs of 23% and 61%. So those two numbers are calculated based on the Fibonacci retracement, the Fibonacci sequence. So when we're looking at the markets, looking for the market to come back to a 50% retracement and then move not just to highs, but beyond highs by roughly 20%. And if it continues through there, we look for it to go to 60% past recent highs. So that's how come up with these targets. So those targets have been hit, and that's something I've been talking about for the last 2 weeks or so, in that if we do breaking that most recent high, the 2296.50, it's going to be a sharp, quick move, and that's exactly what we got. If we move forward a little bit more, actually, let's move back first. And if we back up to last Thursday, so that would be this bar here, the 9th, the breakout bar, the back up on the 512 tick chart, show you the entry into the breakout. So here's Thursday, a little bit of a gap up, and but not to new highs, just a gap up from the prior day's close. And the market proceeded to break the trading hours only high by 1 tick. So highs was 96.50s, and in the morning, about 30 minutes after the open, market broke highs by a tick. And once the markets can establish some sort of direction on the morning, then I like to draw from the, in this case, lows to highs, because the market established an uptrend. And we're able to allow the market to pull back a little bit before entering, rather than chasing the market at highs or trying to get short as the market's making new lows. Let the market show its hand, if you will, and then pull back to, and I'll use the 50% line, let the market pull back a little bit before entering. So the market established a trend off of the open, and we broke highs by a tick, pulled back to the 50, and then we were off to the races and taking off. And so way to manage a trade in this position, one thing I talk about in the live trading room is a couple of different trail stop methods, and the one that I'll talk about here in the context of breaking out to new highs is trailing swing lows. And then the reverse is true for shorts, trailing swing highs. But when we pull back to a 50 and we're about to break out to new highs, in this case all-time highs in the S&P, once the market makes a new high, pulls back, and then makes another new high, then I'll take my stop from the initial entry, put it underneath the next swing low. So the market has already made this first high, pulled back, and then it has to make the next high before I'll move it, because that swing low can't be officially established until the previous swing high is taken out. So I mean, it's pretty easy to look at the market and say, well, here's a swing low, next swing low, next swing low, and they continue to get higher. Each swing low gets higher. So just moving your stop underneath, keeping it underneath each swing low, is a good way to stay in the trend longer than just a few minutes. But the way to know when to move your stop, so if my stop is right here underneath the swing low, I have to wait for the market to not only pull back, but break out, breaking the swing high, making a new high. Then I can move my stop up underneath the next swing low. So the market pulls back in this case and makes a double bottom, doesn't take out our stop, just using one tick below, continues to make a new high, and I'll just leave my stop at that current swing low. Market pulls back, makes a new high. I can move my stop up underneath the next swing low. Here's a good example where the market just pulled back a tick, made a double top. I didn't move my stop, leave it alone, let the market, then the market pulls back a little bit lower, makes a new high. Then I can move my stop up underneath the next swing low and just continue on until the market makes a new high, pulls back. In this case, it does not make a new high, so just leave my stop alone. And then, so we had a double top, the market pulled back. Now, if you've got a couple contracts on, and you get a situation like this where the market makes a double top and you want to move one stop for maybe half the contracts up underneath the swing low that made the double top, you can do that. But I like to try to keep as many contracts on as possible. So stop still underneath the prior swing low, market pulls back, continues to make a new high, pulls back. We just continue on all through, basically until the end of the day, till we got the little bit of sell-off into the close. And so, it doesn't take 15, 20 trades in a day to be able to make money in the markets. And if you just adjust your trail stop methods based on the market conditions, meaning if we're breaking out to new highs, being a little bit more conservative with your stop, instead of trailing each candle, in this case, trail swing lows, or a really good way to take advantage of both a conservative and an aggressive trail stop approach. If you have just two contracts, the first contract, you can trail each candle, be very aggressive. Every time a candle makes a new high, you're bringing your stop up. And then the second contract, you can trail swing lows. And that ensures that if the market makes a quick spike and reverses, you've got profit locked in. And if the market continues on throughout the rest of the day, you've got a big profit locked in. And that way you can trade the same way each and every time. And for that reason, I like using trail stops versus just setting an arbitrary target, because you never know when the market is going to continue to run. So that's a look at how to get into a situation like this where the market is running, that you don't have to necessarily enter, exit. You can get in and stay in. And then, over the next couple of days, the market continued to move higher, and we saw this similar scenario on Friday and then today. Now, moving forward, given that we are up at the negative 23 of the smaller daily retracement, and then at the larger daily, almost weekly, monthly retracement, the negative 61.8, the market starts to almost go straight up. And when that starts to happen, we get these trend lines in here, where we've got kind of a shallow trend line, and a steeper trend line, and a super steep trend line. The market is going to make a larger correction at some point. It can't go up forever. And so we should start to see there's some sideways movement over to the next trend line, or more of a bigger sell-off down to the third trend line down here. But the market's not going to go straight up for a month. There's going to be some sort of consolidation as either buyers take profits, or there's just no more buyers out there. So use caution up here. I suppose one other thing I'll mention is, we talk about these daily moves a lot, but we're looking at a E-mini contract, the futures contract. Now, I don't hold my futures contracts overnight. So if I want to trade the daily move, get in at the daily 50% and just hold out for the negative 23. There's a couple things you can do. You can trade a weekly option on the futures, or just simply trading the SPY or the underlying stock and holding that overnight to the target is a good way to take advantage of the daily moves rather than trying to get in the futures contract and hold that overnight. So I hope that was helpful. We'll be doing another live trading session tomorrow morning, Tuesday. You can check that out, eminimind.com. I hope you have a great week. We'll talk to you soon.